Welcome to Traders Corner. Joining me, as always, is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we will start off, as per usual, with the S&P 500, and it is getting very, very interesting because you've got this option structure. It expires in, what, 2 or 3 weeks' time?
Yes.
So it'll be interesting to see where it lands up.
Very interesting. It certainly is on the cusp of moving into the profit zone for us now, which is quite exciting. These options of ours expire on the 15th of September, so that's Friday, 2 weeks' time. So we've got around about 2.5 weeks to run with this thing. And if you have a look, this is the chart of the S&P 500 that's up on the screen here right now. So I identified last week the fact that this year-to-date upward trend that started in January and joins all those low points quite neatly, that uptrend has actually been broken to the downside now. And that also corresponds with a break below the 50-day moving average. And you can see now the price has been pushing up and it's testing the underside of that prior upward trend and also the underside of the 50-day moving average. And all that resistance comes in at around about 24.50. So thus far, it seems like it is struggling a little bit at that area. And as we sit here today, the S&P futures are down quite a bit following the geopolitical tensions in North Korea firing a missile and whatnot. So it does look as if there's potential for another leg to the downside here, provided that 24.50 resistance holds. Now, in terms of our option structure, you can see the payoff profile on the right-hand side there. That is a put spread option structure. It starts to work for us below 24.30. And the S&P futures, when I left my office just now, we're trading just below 24.30. So with 2 weeks to go, 2.5 weeks to go until expiry, we are right on the cusp of potentially moving into a nice profit on this trade if the S&P 500 were to take another leg to the downside here. And to me, that looks fairly possible at the moment. And I do wonder whether we're not maybe starting to see the formation of a right shoulder on the S&P 500 over here, which may lead to a little bit of further weakness in September. Look, I hope so, purely because of the fact that we've got this option structure, and if it moves into the money for us, we'll do very nicely.
I mean, it's not much of a retracement, as you say. And in fact, to be in your maximum profitable zone, it's what, about 100 points, or even less?
Yeah, even less. I mean, it's from here to our maximum profit zone. Our maximum profit zone starts at 23.80. So that's only 50 points from where we are now. So that is 2% below the current level.
But having said that, you know, the grind high this year has been incremental. So it's I don't know if it's likely to expect that the drop might be a bit more pronounced as opposed to just inching slowly lower.
It's difficult to say. Look, often when markets move lower, they move lower much more quickly than what they move higher. There's always the saying that the bull climbs up the stairs and the bear falls out the window. And even if you look at this S&P move over the last year, you know, the grind higher has been quite slow. But as you can see, also a lot of the pullbacks have been fairly sharp. But having said that, you know, just here's an interesting stat: the S&P 500 has not had not had more than a 3% pullback since November, when Donald Trump won the US election. It's the second longest stretch in history where the S&P 500 hasn't had a 3% pullback. So you know, we are getting more and more ripe for a deeper pullback, I suppose you could say.
Yeah.
And technically, it does look as if support levels have begun to break, and maybe, just maybe, this thing does start to get a little bit vulnerable. And also remember, we've now got this increased geopolitical risk with North Korea having fired the missile over Japan. Donald Trump hasn't yet responded to that as we sit here right now. We don't know how he's going to respond, whether it's just going to be a barrage of tweets as usual, or whether he's going to do something. Yeah, whether he's going to do something a little bit more serious. But I mean, we wait and see. Markets don't like uncertainty, though. Yeah.
Well, let's cross fingers for a bit more uncertainty, because that'll certainly pay off for us. And the top 40, we'll talk about the position that you have there, because it also then relates to a trade that you've put on this week.
Yes, that's right. So here we've got the top 40 future, which we look at each week. And what's notable here is that obviously we broke that upward trend from early July recently, and then we had another push to the upside now in the last week or so. But we've actually also broken below that steep uptrend of the last week. And if one zooms in on this recent trading action, there's actually a little head and shoulders pattern here, which we'll look at in a minute when we look at the hourly chart of the top 40 future. What's also interesting to note here is the negative divergence on the RSI. So what that means is that our RSI is making a lower high, yet the price has made a higher high. And that very often is an indication of slowing upward momentum, and you usually see that kind of setup before a pullback begins. And not much in technical analysis has any predictive power.
Sure.
Most of it's historic backward looking. But when you look at your divergences on your momentum indicators, such as an RSI, that does have a certain degree of predictive power. And looking at this, that negative divergence is warning of a potential slowing of upward momentum and the potential for a pullback, which it looks as if we're starting to see that today. You can see today's candle has actually broken that upward trend of the last week or so, which suggests we could be in for a bit of a pullback.
That's a daily chart. I know you've got a sort of a more detailed chart.
Yeah, so the more detailed chart here is the hourly chart now. So that previous chart, every candlestick looked at 1 day's worth of trading action. Here we're zooming in, and you can see this basically is the trading action for the last half of August, effectively. We're only looking at about 2 weeks worth of trades here of hourly candlestick patterns. And what's evident here is the head and shoulders pattern that's formed over the last 3 days on the top 40 future. And this morning we've seen the market gapping down below the neckline of that head and shoulder structure. So typically what you do is to project a target, you take the height of that head structure from the top to the neckline, and you take that distance and you project it down from the neckline to a target, which comes in at around about 49,300 here. But my sense is that there's a big gap in the chart down there at 49,000. That goes back about a week or so. And my sense is that that gap is probably likely to be a target if we see a deeper pullback here, then that gap is probably going to be a target in the week ahead, I would think.
Guys, just going back, I mean, would that contribute profitably to the option structure that you have against the top 40?
If we quickly look back at the option structure here, you can see the payoff profile of the put spread option structure on the right-hand side here. We actually would need the market below 48,000.
Yeah, okay.
Now that's still a fair way away, but do keep in mind this option structure expires on the 21st of September, which is still 3.5 weeks away. So it's getting closer, but it's still, that's a fair distance away. A lot can happen in 3.5 weeks in the market. So if I'm brutally honest, I don't think we're going to make money out of this option structure. I think we're probably going to end up losing our premium, and that'll be that. But you never know. If we saw a sudden sharp pullback like what we saw in June of this year, who knows? We could sit here in 2 weeks' time and say suddenly we're actually in the money on these options. So I'm not going to write it off entirely, but it's looking less and less likely at this stage.
The interesting thing is that now you've actually gone short of the market. So, I mean, I'd almost say, are you sort of doubling down, but not really, because that option structure is that far away, but you've taken a short position on the top 40.
I have. I'm basing a short position on the top 40 here off of what I'm seeing on this hourly chart of the top 40 future, and we're actually trading it with the All-Me future. So just to differentiate, the All-Z future is the big contract, if you will. It's 10 Rand per point. The All-Me is a little one. It's like a mini contract. That is 1 Rand per point. So what I've done is I've gone short 3 contracts of the September All-Me future. I've gone short at 49,725. Stop loss is above the top of the right shoulder of this head and shoulder structure, which is at 50,100. And my projection is looking for a move to go and fill that gap down at the bottom there, down at 49,000. So let's see. And yes, am I doubling down on the short position? Not really, but yes, we have an exposure via our option structure anyway. We've got effectively a short exposure there. It's slightly different in the way it's constructed. And then this is actually a directional trade, sort of a naked short position, if you will, with a stop loss and a defined target and everything like that.
Yeah, so
and in this case, we would probably know our fate fairly quickly. Whereas with the options, as you know, we have to wait for what feels like an eternity to get our profit or nothing.
Especially if it's working against you.
Yeah.
Okay, so as you say, this is a naked short position. So if you go through the mechanics of this trade in a bit more detail.
Yeah, so we've gone short of the 3 September All-Me futures at 49,725. Keep in mind that every contract here represents 1 Rand per point. So effectively, we've got almost 150,000 Rand short exposure here. The stop loss is 50,100, which means that our risk is 375 points. If we take the fact that every point is worth 1 Rand and we've taken 3 contracts, then it means that our risk is 1,125 Rand, which equates to just over 1% of our account value on the South African portfolio. The target is 49,000 that we're looking at, which means that our risk to reward ratio here is almost 1 to 2. which is decent enough for me to warrant taking a trade.
Yeah, and 1% of the account, I suppose you've got a few open positions, and also it's a naked position, so you don't necessarily want to go too large.
Yeah, I don't want to go too large. Also, we do still have our option structure sitting in the background, so we've effectively got some sort of a short exposure there anyway. So I didn't want to go excessively short here. I was quite comfortable just to take a conservative risk of 1%.
When I brought this up, I'm not sure if it was last week or the week before, but for a natural bull, I've never seen you enter into so many short trades before in the history of the show, Garth.
Yeah, that's right. Look, I mean, we have done 2 long trades recently in Clicks and in Unilever, but you're quite right. I have done a lot of shorts this year, more than usual. And to be fair, I haven't gotten most of them right, which is probably why we're not looking as good this year as what we have on the show in previous years. You know, I always say it on my courses. I say I've never met a rich bear. I've met a lot of rich bulls, but I've never met a rich bear. So maybe I need to just, you know, pull my claws in a bit and become a bit more bullish. I don't know.
Yeah. Okay. Well, let's look at those other 2 trades that you mentioned briefly.
Yeah, these are trades that we've done recently. So this was last week's trade, which was in Clicks, and you can see what I was looking at here was the solid upward trend that goes back to December of last year. You can see how nicely that trend line joins all the low points on that chart. We bought 600 CFDs of Clicks at 143 Rand 60 with a stop loss at 141 Rand, and we're looking for a move back to the recent highs at about 150 Rand here as a minimum target. So far, this is still looking good for us, so I'm happy to keep holding this trade. Nothing wrong with this, so we just sit tight and run it. And then the other trade that we did a little while back, or we did it 2 weeks back, in fact, was on Unilever. And this is on our offshore portfolio, Unilever listed in London. So we traded it in pounds on our offshore portfolio. And what I was seeing at that stage was the inverted head and shoulders pattern, which is pointed out over there. And I said that it looked as if it was going to break the neckline of that structure and then move on to a higher target. We've got a target of £46 here. We bought at 43.50. We went long of 140 CFDs here with a stop loss at 42.50. Target is £46. It's still working out quite nicely for us, so I'm happy to sit tight and hold this trade for the moment.
Yeah. Okay. So those are running nicely. Garth, in that case, what does the portfolio look like? Because you have actually been quite active in the last 3 weeks.
Yes, although we've been fairly active, the portfolios actually haven't really moved around much from last week. So here's our South African portfolio. We still have our put spread option structure there. The Clicks position from last week, which is running with a profit of 1,800 Rand. And then here's our short position on the ALMI future from this week. So we're sitting up 6% for the year to date on the portfolio there, on the South African portfolio. And then on our offshore portfolio in pounds, we've got our put spread option structure there on the S&P 500, which runs for another 2.5 weeks. And then our Unilever position is working for us. We're up £211 on that structure, on that trade rather. We are still down 4.5% for the year to date here, so still obviously looking to try and get back on the right side of the ledger. And if that S&P 500 option worked, that would really be a big kicker for us in terms of this offshore portfolio. So I guess I am sort of holding thumbs that we're going to see some sort of a positive resolution to this trade in the next 2 weeks.
I mean, theoretically, you could go to break even or even positive position.
It's very close. It's right on the cusp at the moment. So, you know, if we just see this S&P coming off at 1 or 2% from current levels into the expiry, we'd look very good on this trade.
Yeah. And then just to end off, Garth, just a reminder that people can get a weekly update from you.
Yes, that's right. If you go to traderscorner.co.za, you can go and you'll see in the middle of the page there is a link to a free weekly email. If you click on that, register your details. It'll take you 30 seconds to do that. Then we'll send you an email every Tuesday afternoon detailing what comes up on the show for that week.
Okay, great. We'll leave it there. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.